So over here, we know we're headed towards, at some point, we're going to head towards this yield curve inversion for this blue line. We also know that the Federal Reserve is going to be hiking interest rates.
That's what they said.
That's what they're saying. They're going to be hiking interest rates. The world, the United States, the U.S. is clamoring for it because they say inflation is through the roof and we need to raise interest rates. They don't realize that what they're asking for is for them to destroy demand, Peter. That's what people are asking for. You're gonna raise inflation. You're gonna raise interest rates to fight inflation, and people don't get it. That what they're saying is that we want some of us to lose our jobs. We want
Hmm.
some of us not to be able to get loans. We want it to be harder for us to start businesses. We want it to be harder for us to live in order to bring inflation down. Like people just don't get that that's what they're asking. And the Federal Reserve is like, okay, then that's what we got to do. And so we see here that the yield curve is falling, so financial conditions are getting tighter. The Federal Reserve rates are going to go up, means financial conditions are going to get tighter, and they've already announced that they've stopped quantitative easing. That means this yellow line is about to plateau, like we saw over here, right?
Hmm.
Well, that's like a car going 60 miles an hour, and then all of a sudden the person puts it straight into reverse. And what do we see? We saw Bitcoin fall dramatically. Now, it doesn't look dramatically over here, right? But if we go back to that chart we were looking at before in a linear way, we saw Bitcoin fall here, right? Bitcoin fell here um, about 40 to 50%. Let's call it 40%, right?
I
Right.
don't like looking at this chart, Tom. I don't like it.
So that means this is indication that the economy is that the money flowing in the system has been uh, has been pulled away. And so it's no wonder that we're seeing a drop in the stock market. What's interesting here is that Bitcoin saw this beforehand, right? Bitcoin peaked here at in November 2021, but the momentum still carried the stock market, and we have here that it peaked in January, and since then it's been going down. So the question now here, Peter, is if financial conditions are tight, as tight as they can be, with interest rates going up, the yield curve falling, and quantitative easing slowing or rolling over, are assets likely to go up or down?
Say that again.
If quantitative easing is slowing, yield curve is falling, going towards inversion, and the federal funds rate is going up in order to tighten financial conditions, that what do you think happens to asset prices? Do they keep going up?
You tell me.
They crash, Peter.
That's what I expect.
They crash. All right. So the question we have right now
You
is,
think asset prices are going to crash? Now, what I was thinking is that there's going to be less money going around, that things are going to get tighter. But why does that make asset prices go down?
because our economy doesn't work on how much money there is in the system. It works on what is the increase or decrease of that money. What is the acceleration or deceleration of it?
That's velocity.
That's the velocity exactly. We don't care how fast the car is going. We care, is it ramping up to that speed or ramping down to that speed? So
And
if I
when
were just
velocity goes down, asset prices go down. Why?
because um, the money created in the system requires old debt to be used as assets to be used as collateral to borrow more money on, and people who have debt who pay off that debt, who pay off the interest on that debt with new debt, right, with the lower interest rate, they keep paying off the old one, then um, they can't do that. And so not only is new money not being created because they're not taking out new loans, their old loans might get defaulted on, which means that money then disappears, and all the things that was built on that money gets disappeared. We saw this happen in the 2008 crash.
I was just about to say,
Crash.
yeah.
You have a house, and the house has there's a mortgage on that house, and so that mortgage uh, is on the balance sheet of the bank, right? They it's an asset and a liability. They're gonna forgive me. I don't know enough about bank balance sheets in order to talk about how they see it, but suffice to say, it's a loan that needs to be paid back. And
Mhm.
so what the government can do, sorry, what the bank can do is that loan can actually be used as an asset. they could sell that loan to somebody else because that loan has this money that's being paid by the homeowner. There's this guaranteed cash flow, right? And like we said before, people don't want just cash. People with money don't just want cash because their cash is losing money every year because of inflation. They wanted to put it in something, so they're always looking for something to buy, right?
Mhm.
So better for them to buy a loan from somebody that's this cash flow coming in, than has this interest rate automatically built into it, than to just have cash alone. Now, once that person, the second bank or the second financial institution buys that asset, now they can also lend it out, or they could borrow against it, or they could sell it to somebody else. And as they use it, as they leverage it in order to get, now that liability now is an asset on the person's balance sheet, they can use that as collateral to get another loan, right? And that loan that they get is a liability on that financial institution's balance sheet, and then they could sell it to somebody else, and that becomes an asset, and then this
But
whole thing.
why
But
does
it's
the
all
asset l- decrease in value?
exactly.
But
So the
why?
asset, no, the asset, the house doesn't decrease in value, right? The house, the mortgage, the loan is a debt to the homeowner who pays their mortgage every month,
Mhm. But you're
and so
explaining why asset prices go down. Why we're expecting asset prices to go down.
so what happens if the so that money, that money's being created from all these loans are going somewhere, right? It's going to buy more real estate to and causes real estate to go up in
Because
prices. It goes
demand
to
goes
buy
down.
stocks. No, I'm just saying in the regular system where
Yeah.
we talked about the house, and that house has a mortgage, and that mortgage is now an item on someone's balance sheet, right?
Mhm.
And so now they can use, depending on how they deal with it, they can use that cash flow item, that loan on their balance sheet, as collateral
Mhm.
for them to be able to borrow money.
Gotcha.
And so they're borrowing money on top of a loan. They're using a loan, they're using debt as an asset
Mhm.
to buy money. To get more money. And so they get a loan, and then that money they might use to buy more real estate, to rent out. They might use it to buy stocks in the stock market, right? So it's just house of cards built on top of debt. Now, if the homeowner defaults on that loan, because financial conditions get tight enough that they get fired, right? They
Mhm.
can't afford that, or they can't afford that home anymore. Well, all the debt that was built on top of that disappears too, because all that other loans were collateral that had this value before because the person was paying the mortgage. But if they're not, then that thing doesn't have any value anymore.
Hmm.
It's a defaulted loan. They're not even going to get the principal back, much less the interest rate. So it goes nowhere. And so uh, debt gets hypothecated, gets leveraged again and again and again. Peter, we're not talking 2, 5, 10 times. It could be dozens of stacks of debt on top of that. And so the last thing the government or the Federal Reserve wants is for the value of the assets to come down, right? Because the whole Ponzi scheme is set on it, right? Pension
But if
funds.
if they increase the federal uh, rate and reduce quantitative easing, they might not want assets to go down, but aren't they causing assets to go down?
Yes, exactly. It's sort of like caught between a rock and a hard place, because
But
what
they're doing
happens
it
is that
because people are demanding it because they're feeling inflation.
exactly. And the people think that the inflation that they're feeling comes because there's too much money sloshing around in the system. And there is a lot of money sloshing around the system, but that money's been sloshing around the system for a decade now and more. We saw the chart, 40 years, interest rates have never gone higher than the previous peak, right? But people have this, they're very linear, they're very short term, so they think that inflation, oh my God, it just started now, all this money printing, we gotta put a stop to it. And so politicians are not gonna get elected if they don't talk about it, and the Federal Reserve chairman will get replaced if there's a problem, and we're gonna fight inflation because people just generally don't understand how these things work. And
So this is
so,
what you explained to me previously that before the Federal Reserve was doing this whole playing in the market, but now a large part of what they do is this expectation game.
Yes, let's not get into that because that's a whole philosophical debate as to what inflation is. But suffice to say, as prices of things go up, it's hurting people. One of the classic phrases is that the cure for high prices is high prices. Eventually, it gets to the point where it's too painful for people. Gas is
Mhm.
high, and food is through the roof, and the rent and medical bills, it just gets too hard, and they demand that the government does something in order to bring the prices down. And the only thing the Federal Reserve can do is destroy demand. Now, people don't realize that the demand is already being destroyed by the high prices because they don't understand the flow of money. So they don't understand that they're asking for interest rate increases on top of what's actually already a tightening system.
So why doesn't
We're
the Federal
actually
Reserve just don't do anything and eventually demand will fall?
because the Federal Reserve needs people to think that what they do actually influences the economy, but it doesn't really. The Federal Reserve doesn't print money. The banks make money through loans. And the banks are not going to want to, if they don't want to lend out money, then they don't want to lend out any money.
Hmm. I
No
get it.
amount of cutting the interest rate is going to, or modifying of the interest rate is going to change how they think. If they think Jimmy is not going to have a propensity to pay this back, they're not going to do it. But they need people to think that the Federal Reserve prints money, because then you go, well, what's the Federal Reserve do? If they don't print money, what is it that they do? So they go, well, we control the interest rate. But the Federal Reserve doesn't really control the interest rate. It's the bond market. We saw that chart at the beginning with the red, yellow, blue, and purple line, right? Well, what happens is that actually, let's take a quick gander at that. So what happens is that right now, let me overlay the rate. So the teal line again is the Federal Reserve line, and the red line is short-term interest rates, 2-year interest rates. Well, do you notice over here it's always the uh, the red line goes up before the teal line does, right? And the red line comes down before the teal line does. Red line goes red line goes everywhere we see it. Red line goes up before the other one does. Red line comes down before the other one does. Here, same thing. The red line um, bottomed here, and it was only a few months later that the Federal Reserve starts raising interest rates. It's the bond market. It's the money that goes into the bond system that actually tells the Fed what the market expects them to do.
Hmm.
And so they have to when the bond market prices move, they sort of have to follow it, right? So over here, if you take a look at what's going on in 2022, the normally by the time the red line got to over here, the Fed should already be increasing interest rates, but they didn't. So the cycle happened, the business cycle is happening, so that the red line is crazy high, and the Federal Reserve hasn't raised interest rates even once
Why?
because the Federal Reserve actually knows that the long term trend is for this to come down, and that they need to stay around zero interest rates. That the economy can't actually handle high interest rates because then the yield curve is low, right? The yield curve is low, like we see over here, and falling. Lending doesn't happen, and things get rougher and rougher. And what happens is that Ponzi scheme of debt disappears as the money disappears. So they know that increasing the interest rate will collapse the economy if they
Then
do it
will
too
then
much.
that yield curve will drop below the red line? Is that what's
Exactly. Well, that'll drop. That's going to drop before it'll always eventually come down. But the question is, what the Federal Reserve was trying to do was wait out this red line. They wanted to wait out this red line for it to come back over.
have they ever done that?
No,
Yeah, I'm not seeing it.
but they had no choice. They were low for the longest time. They tried raising rates. They got their rates back up to 2.5%. The previous cycle had rates at 5%. They couldn't even get back to half. They got back to half of what the interest rates were before because they were like, "Holy crap!" When they raised interest rates over here, what happened was that the stock market just puked. This happened in the stock market, and they're like, "Whoa, whoa, minute, let's back it up there." So the last thing they want is to, I mean, hell, if they could keep it at zero interest rates forever, I'm sure they would prefer to do that. I mean, that's what Japan did, and so now they waited and waited and waited and waited, and then like commodity prices go to the roof, and then Russia decides to invade Ukraine, and prices go to the roof, and they're like, "Oh my god!" People are screaming inflation, and for a year they're like, "It's transitory inflation. It's transitory inflation. Inflation's not going to last long, last long." And now they're like, "Hey, well, no, inflation's lasted a long time now. We need you to make things harder for people." And so they're like, "Okay, we gotta." We'll see. We'll see what happens tomorrow. We're gonna find out if they raise interest rates. All right. So that doesn't matter to us. What matters to us is that we know they put in the car into reverse at exactly the wrong time. So the question is, how much further have we reached a bottom in equity prices in the stock market and in Bitcoin?